revenue is a meaningless number. It doesn't help anybody. It's a vanity metric. You're in business to generate a return for you and your family. You are not in business for the sake of growing your business. Ask your accountant or your bookkeeper, hey, what's the average percent I usually pay in GST? Those are the two easiest ways. Put the money in a separate bank account. Don't touch it. I'm Matt Byrne from Day One Advisory, and on this episode of Add to Cart, I share the importance of having a good grasp and understanding on your numbers so that you can have more control over the direction that your business is going.
If your revenue doubled tomorrow, would you actually make more money? If Meta shut you off next week, would your margins survive? And do you actually know what your break even is? Or are you just chasing a number that sounds impressive on LinkedIn? Hey, it's Nathan Bush or Bushy here, joining you from the land of the Turrbal people here in Brisbane, Australia. And today I am joined by Matt Byrne, who is the founder and the director of Day One Advisory. They are an e-commerce focused accounting and advisory firm working with Shopify brands all across Australia. Matt and his team act as an outsourced finance department for e-commerce brands, managing bookkeeping, reporting, cash flow, forecasting, tax planning, and most importantly, turning messy numbers into decision-ready insight. He works directly with founders navigating the crunches that come after peak inventory debt decisions, making sure contribution margins look healthy, and the tension between going for growth and actually paying yourself. In this episode, I wanted to talk finance deeper than revenue doesn't matter. You've got to be concerned with profit because we've done that a couple of times. I wanted to go the next level deeper, especially for those founders in the room. Today, we unpack the three numbers that actually tell you if you have a real e-commerce business, why contribution margin is arguably more important than gross profit. We talk about how to calculate your break even properly. We talk about when debt makes sense for your business and when it might be a slow motion disaster, and the uncomfortable truth, the awkward conversation sometimes around founders and whether they should pay themselves a salary. So a big thank you to Shopify and Klaviyo for supporting Add to Cart always and helping bring practical e-commerce conversations like this to life, especially when they're free. I mean, how good's that from an accounting point of view? All right, let's get into it. Here's my conversation with Matt Byrne from Day One Advisory. Matt, welcome to Add to Cart.
Hi, great to be here. Thanks for having me.
Brilliant to have you here. I always love our financial conversations when we have our financial experts in because I always learn something new around the foundations of e-commerce businesses. So I'm excited to get into that today. I've got to ask you before we do, what gets you out of bed every morning to help e-commerce businesses with their finances?
Well, I love the phone calls. I love having chats with people. That's my favorite bit. I mean, I'll be the first to admit I'm not a big fan of doing tax returns. It's part of the job, but I like the phone calls. I like chatting with people and I like being able to provide some insight to them that's going to make them enjoy their business a little bit more and hopefully extract a bit more profit out of it because I suppose that's what it's all about at the end of the day.
Tell me about the types of phone calls you're getting so far this year. Are they good phone calls, bad phone calls? Are we in panic mode? Are we feeling optimistic?
To be honest, I think most of them have been pretty bad. People are a bit pessimistic coming into the new year, but I mean, it's a quiet time for e-commerce, right? Everyone's just had this massive peak. They've got a bit of downtime. They're starting to reevaluate things and think about what's happening in their business. And so naturally, as sales decline in January, February, it's kind of that is usually where these conversations come up. I mean, the conversations we're having pre-Christmas were opposite end of the spectrum. Everyone's stoked. They've just come off all the sales and numbers look really good. They've basically banked all their profit for the year. And yeah, now we come into January, February.
Stuff gets real again.
It gets real again and cash flow hurts and you start getting emails about your BAS lodgements coming up from, you got to pay the GST for all of those lovely sales you made. And so there's a bit of cash flow crunch for the next couple of months. So it's kind of what happens every year. Everyone gets a little bit panicky, but it's okay.
Does it feel the same as every other year in terms of the level of panic? I'm just trying to get a gauge on where founders are at in headspace for 2026.
I think that overall business owners are optimistic people by default, right? That's why they're in it in the first place. But I think that there is now it's not conservative, but I think people are more worried about things. And I think that they're more intent on protecting the downside of it.
Yeah.
And so they're starting to invest a little bit more energy and thought into how do they continue business, but continue in a way that's going to, make sure that they're still here next year and the year after
Yeah.
and that sort of thing.
I suppose there's a lot of businesses too who, especially in e-commerce, who came through that COVID era and experienced the highs of the highs and then post-COVID, the lows of the lows. So now got scars on both sides and being a little bit more balanced around approach, knowing that it can be really good, but it can also be really bad. And we've got to set ourselves up for a solid baseline,
Yep,
no matter what the
absolutely.
world throws at us.
Yeah, and I mean, there's been plenty of turmoil and uncertainty in the last couple of years alone, and so I think, yeah, people are naturally worried about that, which is good. It's a good thing to do. It's a good thing to be to protect your downside risk.
All right, we're going to dive into some numbers to help unpick what good looks like. But before we do, can you give me a little bit of an overview on Day One Advisory and the types of e-commerce businesses that you're helping so we can get some context around our conversation today?
So we work with Shopify brands using Xero. We are effectively end-to-end accounting and bookkeeping support. So we deal with the day-to-day transactional stuff, the bookkeeping, payroll, those types of things, through to monthly reporting and closing out the books. We manage their sort of finance app stack as well to make sure that everything's talking properly, make sure that their inventory reporting is right, etc. And then we go through to things like tax planning and tax returns. So we tend to work direct with founders and we work with them from, we're effectively their outsourced finance function for their e-com business.
Okay. And you mentioned Xero there. Is Xero the only financial software platform that you use?
It's the only one we use. Yep. I mean, the other one is QuickBooks that you'll hear about. And certainly in the US, it gets a bit more traction than it does in Oz. As an accountant, there's some functionality that's missing. And so we find that Xero is the better option. And to be honest, 95% of businesses in Australia are operating on Xero already anyway. So we rarely come across anything else.
Yeah, okay. One of the things around Xero that we often hear is being able to reconcile on an order by order basis. For e-commerce, it's not as easy as when you're doing B2B reconciliation.
Yeah, it's horrible. I would never recommend it unless you fancy spending all of your time sitting in front of your computer doing bookkeeping. It is a horrific way to do your books, and there are much easier ways to deal with things. And there's wonderful bits of software like A2X, for example, that will go and get that Shopify data and it'll bundle it up nicely and it'll just park it in Xero in a few payouts each day, and it will make everyone's life a lot easier.
Beautiful. Good tip there, straight out of the gates with a brilliant tip for anyone who's reconciling order by order still. Now, tell me, when you go in and talk to a new e-commerce client for the first time, and like you said, you're probably speaking to a founder, what are the three numbers that your eyes go to straight away to try and understand where this e-commerce business is at, whether it's a healthy business?
Yep. The starting point is always gross profit. I mean, very rarely will we look at revenue in isolation. It's tends to be a useless metric most of the time. So we are always looking at gross profit. So do the products that they sell have enough margin in them so that they can advertise them and sell them to the customers? And then there's enough left over that it's going to cover their overheads.
What does a good gross profit look like to you?
Oh, I mean, it depends on the business, right? Like I've got a client who sells digital products. Their gross profit is enormous. They have no product costs, no delivery costs, etc. Right? So their gross profits must be 90% plus. If you've got a standard sort of typical e-commerce business that sells and delivers products, I would say a good one is in the sort of at least 50% mark. Our client base that sort of does really well and the ones that have a lot of margin available that ultimately leads to profit and net cash, they tend to be doing around the 60-65% mark, which is pretty good.
And do you find most businesses have that margin from the outset, or do they build towards it? Like we hear a lot around people who are looking to buy an e-commerce business or launch a new e-commerce business. Do you find that they go out with the margin predetermined, or do you have to work your way towards that 50, 55, 60, 65%?
No, I think gross profit margin should generally work from the beginning.
From day one.
Your unit economics have to work. Yes, you're going to get some benefits of scale. So as you start ordering bigger volumes, your suppliers will give you some volume discounts and you might, your proportionately your freight costs are going to be less. But ultimately, I think that is a few percentage points. It's not 20% or 30%. Yeah. So if you're going into business with a 20% margin or 80% product cost, and you're thinking that there's some magic bullet that at $5 million of revenue, that's going to end up being, dropping by half. I think that's probably a little bit too optimistic.
Yeah.
And I think unit economics should work from the very first day you start selling. And if they get better, awesome. But if they don't, well, you're still okay.
You've still got a business.
Yeah, absolutely.
All right. So number one metric, gross profit. Number two?
Contribution margin. which is basically gross profit minus your direct ad spend.
Yeah. Okay.
So really we're looking at, well, you can call it a few different things. Contribution margin, you can express it as MER or blended ROAS or whatever you want to look at it as. But basically, are your selling costs low enough that they're going to leave some margin left over? Right? I've actually seen quite a few businesses where they have a reasonably healthy gross profit margin, but they spend so much money on acquiring the customer that actually it's all gone.
Yeah.
And so the number that really matters is your contribution margin, because that is how much is left after you've done everything that you possibly need to do to deliver that to the customer. And the reason, I mean, I actually don't know if this is a real thing or not, but I say that contribution margin is how much is it contributing to paying your overheads and your profit.
Yeah. Okay.
So that's the way I look at contribution margin. It's how much is it actually contributing to the business. Everything above that, it's not really your money. It's just the cost of getting that product out. So gross profit margin is important, but you have to then have some left over after you've acquired your customer.
Okay.
So I would argue contribution margin is more important than gross profit, but they're sort of all interconnected a little bit.
But I suppose you've got a little bit more to play with contribution margin. You can pull it back and you've got a few more levers in there, don't you? Rather than gross profit is your gross profit. There's probably not much in
That's
there
true.
unless you change your product range.
Yeah, I suppose you can go down some different ways of selling your product that maybe don't cost as much, et cetera. But yeah, you're right. But ultimately, you've still got to have the contribution margin available in order to use it to cover the cost of your business and pay yourself some money.
And when you are working with businesses, roughly what percentage of revenue would you say is healthy to be spending on marketing and advertising?
Again, it ranges. I think, I don't know, I tend to see businesses like less than 30, 35%.
Okay.
I think as soon as you start going above that, you're really going to start to struggle. But again, it depends entirely on what your unit economics look like. So going back to my example before, if you've got a customer who sells a digital product with no deployment costs, well, they can afford to have a ROAS of 2 times because they don't have other costs to deploy, so they can sell that.
Yeah.
If you've got a product where you've only got a 50% margin, well, you are going to struggle if you spend 45% of your revenue on ad spend, right?
Yeah.
So if your business is healthy and it's doing, I don't know, 65%, and then you go and spend 25% on marketing, I think that is probably a pretty healthy number. I'm no marketing guy though, right? That's definitely not my department.
You're the guy who comes in and slaps the marketing team around when they're spending too much.
I think that you need to have clear expectations of what your budget is on your marketing, so then you can keep people to account, right? So they don't go crazy with the spending.
There's a big line of thought around e-commerce at the moment around scaling marketing when it's working. So doubling down on campaigns or ads, especially in Meta, that are working, especially to acquire new customers. How do you feel about that from an accounting perspective? When you talk about that, it's like having a really clear view on how much you're spending and the contribution margin. If you've got a team that's like, actually, if this campaign's working really well, just keep going until you're stopping seeing that return. How do you manage that?
Well, again, that's not usually my department, but I've had this conversation, I think, at least 4 times this year already, where my advice has been to spend more money. And that's not usually the advice that comes from accountants, and certainly a lot of accountants who don't deal with e-commerce. I was having a conversation with a client the other day, and the conversation from their existing accountant or their previous accountant was, you actually need to spend less money on ads. Like, you're spending too much money on ads. And it's like, well, that's great in another business, but it's driving the sales. And it's driving the contribution margin. And this was a business that had good margins, like it could afford to do it. So my view is kind of, well, if it's working and it's within your margins to do that, then keep going, because for every dollar that you spend, as long as you've got the product to fulfill it and the customers that are going to keep buying it, well, go for it. In real dollar terms, it's profit. Happy days.
Great. Okay. So we've got gross profit, we've got contribution margin. What's your third metric that you're really keeping an eye on?
Breakeven. So the breakeven point is effectively how much product do I need to sell at my contribution margin in order to cover all of the overhead cost of the business. And this is one that I think doesn't get looked at very often. And I think it's a really good metric to track, because what it does is it gives you context in terms of what revenue is a good target for you. I mean, you'll hear everyone jumps online and every guru will talk about what their sales are. They'll spin up their Shopify dashboard and it's like, well, fantastic. I've done $5 million of sales over the last, 5 years or what have you. And you go, that's great, but it's meaningless. Like revenue is a meaningless number. It doesn't help anybody. It's a
Looks
vanity
great on
metric.
LinkedIn.
It looks great on LinkedIn, but it doesn't provide anything in terms of free cash flow or profit or
Yeah.
anything like that. So having your overhead cost and understanding your break even in terms of sales dollars and product volume and that sort of thing then gives you purpose. Like, why are you trying to sell $1 million of product if you can actually make the profit you need to at 600? So it's context. And I think that it's I think every business owner should know their break even. And then you should be obviously trying to sell enough product to cover those costs and make some profit.
And those overhead costs are predominantly team members, stock, warehousing, physical premises. Anything else?
Not even stock. So stock's always going to be above the line, right, in terms of your growth profit. But yeah, it's going to be your general subscription costs, wages, rent. Those tend to be the big ones for e-com businesses. I mean, these days, subscription cost is probably second on the P&L behind. I would hazard actually even probably overtaking rent for a lot of businesses. People are
Really?
spending $5,000 a month on subscriptions and stuff.
Yeah.
Well, you think about what
That makes
Klaviyo
sense.
costs, for example, Shopify, those things, they add up pretty quick. So those are your overhead costs. The thing that people notoriously forget to include though, which is, I think is just boggles my mind, is their own salary.
Yes, I was going to ask you about this and what you're
Crazy.
seeing from founders when they get to that profit line, when we're covered costs, when we're at profit. Are you finding founders are actually taking a salary or are they reinvesting back into the business? Like, how are most thinking about that profit? Because I can imagine when you're scaling, the excitement is high. There's always more stock you can buy, there's always
Yep.
more ads you can run to keep growing that business. What is your advice to founders when you're like, actually, you need to live as well?
I am always a big advocate for taking a salary at every stage. Now, it might be smaller, or it might be larger. It depends where your business is at. You're in business to generate a return for you and your family. You are not in business for the sake of growing your business. I think
Yeah.
people get tied up too much in I need a business that does $1 million because then I can tell my friends I've got that's what success looks like. E-com businesses are incredibly capital intensive, particularly when you're growing, right? Because you are just constantly reinvesting your profit into your next stage of growth through inventory and new staff and what have you. There is always going to be something else, as you said, to put money into. At some point, you have to take something out. And so I'm a big advocate for doing that at the beginning. And then there's times in your business when you do need to you need to reinvest, right? And you need to push for growth in it. I find that if you have a salary and then you need to make the choice to stop taking it, that's a very different mindset to never having it in the first place.
Yes. Or waiting for the day where you go, actually, there's a bit of money there. I can take a dividend out of this.
Yeah, exactly. I think that you should be on the books for whatever it would cost to replace you. And I know, like from the very beginning of my business, I've always paid myself a wage, and that wage has changed over the journey. I mean, when I started, it was nothing. It was, we're paying the mortgage and that's about it. And it's grown over time, but it changes my mindset around how I approach my business and how I approach the growth in my business. And I think, like personally, I've made the decision to actively slow down the growth because, well, I don't want to forego extracting something out of it in the interim, particularly if, like, let's say it's going really well and then one day it doesn't and it stops for some reason. If you get to that point and it's not worth anything and you haven't taken any money out and what have you, then it's sort of a hard pill to swallow. Whereas if you've taken a living wage out of it the whole journey and then it still goes to shit at the end, you go, oh, well, look, at least I paid myself along the journey as well.
I think it's a really good point. And I'd love to dive into founder mindset here with you as well, because obviously from the publicly listed companies, there is always going to be pressure for growth. Publicly listed, as well as if you've got PE behind you or other investors, there's always going to be that push for growth. But when you're starting out and maybe you're between that $0 and $10 million mark, you're probably going to own most of the business yourself at that
Yep.
stage. That desire and that pressure for growth rather than paying yourself and living a good life. And like you said, not scaling for the sake of scaling. Where do you think that comes from? Like, what kind of mindsets have you seen there?
I think it's ego and it's people wanting to impress other people, but not really understanding why they do it. We have this conversation all the time with people is they'll give me their target, like it's 10 mil, right? Like I've got to do 10 mil of revenue. And you go, cool, awesome. Why? Like, what's the point? And they go, oh, well, because at 10 mil, I'll make $1 million and then I can do this. It's like, okay, well, why? It's like, oh, I want to spend more time with my family. It's like, cool.
Yeah.
What if you just did that now? Like, what do you need to do that? Oh, I'd love to make 150 grand a year. It's like,
Yeah.
okay, cool. Why don't we just do that? Why don't we just aim for, why not start there? Like, why not do that now? And so I think part of the job is like, what's the target and why is that the target and what's important to you? And 99% of people I talk to just want a business that can provide them the lifestyle so that they can spend more time with their kids
Yeah.
and earn enough money to do it and be proud of what they do and enjoy their business. And
Yeah.
that, in my experience, rarely requires you to do 50 mil or 100 mil or anything like that. You can do that at $2 million or $1 million.
Yeah, because there's plenty of big shiny stories, the LSKDs of the world, where you look at what Jace has done, an incredible business, blown it out, 30 stores now, going international, White Fox, you know, like there's so many great Australian stories, which is fantastic, but they're the rarity, aren't they? Like in
Absolutely.
terms of there's this big gap in between. So setting your sights on running a sustainable business that can pay you a wage very comfortably, let you sleep at night, and then if you find the opportunity to grow it and scale it, fantastic, chase it. But setting your sights on being one of the 0.01 percenters from the outset is probably a hard thing to get your head around.
Yeah. But I also think that you can scale, but just why does it have to be right now? Like, why does it
Yeah.
have to be tomorrow that you hit that target? Why not do it a little bit slower? The other side is, I think you can do that, but I think you can do that by still taking a wage.
Mm.
Like more often people will sacrifice and take nothing out of their business and put everything back in. I think that you can sort of have your cake and eat it too. If you're talking about a business that does $5 million or $10 million, I mean, 150 grand salary is really not a huge amount of money in the scheme of things. So if you just choose to prioritize that and treat your wage as an overhead cost of the business that just needs to be there, like it would with any other employee, then I think that scale after that. Like use
Yeah.
everything after that to scale, but at least you're getting something out of the business.
There's also a mindset thing there, isn't there? Especially as you're growing and you're bringing on new team members, whether that be customer support or whether you bring in GMs, when you're paying other people, if you're not rewarding yourself for how much you're putting into this business, it almost becomes a bit of a tension piece, isn't it? That I'm paying you to do all this.
Yeah.
I'm not taking anything myself.
Oh, it's crazy. And I've done the same thing in the past. I've employed, managers who in accounting firms get pretty good salaries and I haven't been paying myself as much as them. And as soon as I go to put I'll be setting their payroll up in Xero or whatever. And I put the number in and then no, fuck this. I immediately I put mine just a little bit above because I think, no, I'm not, this isn't the purpose. Like the purpose of this business is not to make other people wealthy. The purpose
Yeah.
of this business is to give me a return and my family a return and to hopefully outweigh the opportunity cost of what else I might have done. And so I always tend to prioritize and encourage business owners to prioritize paying themselves something. It's not going to be $500,000 or anything like that, but enough, like pay the mortgage, take the stress out of it,
Yeah.
put some stuff in your personal bank account. Then I think it changes I think the other thing, it changes your mindset in your business because you start making different decisions about your cash because you go, well, my family likes, like me over here, my family, we get our money come into our personal bank accounts every week or month or what have you, and we deal with that. Then you're over here as a business owner and you're going, well, what am I going to cut? Am I going to cut my salary? And then as a person, we go, hold on a second. I kind
You're
of like
arguing
that
with
money.
yourself.
Yeah. Whereas if it's never in there in the first
Yeah.
place, I think people tend to find it easier to reinvest it for some reason. Whereas I think you have to get a return out of it just for your own sanity, I think,
Yeah.
and stress and that sort of thing.
Makes sense. At least play the tax thresholds to the right level.
Oh, 135 is the number at the moment. That's take the salary. Obviously, you don't want to go and rip $500,000 out and not think about how you're going to manage the tax on it, obviously. But there's a sweet spot and a combo there.
One of the things that we've been talking a lot about on Add to Cart so far this year is decision making, because I feel like this year more than ever, decisions will need to be made quickly, but with great visibility to the numbers and the consequences of them. We've got a world that's changing so quickly, and the ones that will get ahead are the ones that can make clear, consistent decisions in
Yep.
their business. How do you help your founders and business owners make those decisions?
I think visibility is the biggest thing. So many clients come to us, like in the discovery call, I'll be talking to them and I say, well, what's your gross profit on your product? Which SKUs make money? Which ones don't? They don't know. sometimes business owners don't know what gross profit is. They actually don't know even how to calculate it, let alone what it is. I think that if you give people the visibility over their numbers at a unit level and at a whole of business level, then it gives them context. And then when they're making a decision, they can go, right, this is going to work. And a perfect example of that is discounting, right? So people will get caught up in the trap of discounting because everyone else is doing it in its sales season. So let's jump on board. But if your business has a 15% contribution margin on a product and you go and slap a 20% discount on it, then you're stuffed, right?
Yeah.
Like you're going backwards. So if you know that your contribution margin is 15% on that particular product, then you know that, you might maximum discount 10%, or instead of a discounting model, maybe go to something like bundling or what have you, or free something. So it gives people information to make a better decision that makes sure that when they go and implement that, it's not going to send them backwards, which you see far too often.
What's your view on the founder who comes to you and says, look, I know this is going to be unprofitable in the short term, whether it's Black Friday or otherwise, but we're going to acquire all these customers that will spend with us over the next 2 or 3 years?
As an accountant, loss leaders make sense in some circumstances, don't get me wrong, but I think you've got to be careful of, is it blind optimism or is there some genuine science behind it? And if it's, I'm going to go and acquire these customers at a loss, but they've got a lifetime value that's going to contribute ultimately to profit, then if you've got the numbers behind you to support that, then sure. But that's like an informed decision that people are making with the stats, and they're going to take the risk and have a go, but they're doing it in an informed way, as opposed to, well, we're just going to do this and hope, and we don't know if it's a loss leader or if it's profitable, or we don't know what our lifetime value is, or what have you.
Underwear brand Nala celebrates difference. Different bodies, different lifestyles, different personalities. That's exactly why they offer more than 80 products across a huge range of sizes, shapes, fabrics, and fits. But celebrating difference creates a challenge because you can't talk to everyone the same way and expect it to land. Personalization isn't optional at Nala. It is core to their mission. From day one, Nala built their growth engine on Klaviyo. By using rich customer data from their online fit library, purchase history, and loyalty program, Nala can segment properly, launch products to the right people, and notify high-intent customers the moment something comes back in stock. The results, they speak for themselves. 6 consecutive quarters of revenue growth, 109 times ROI from Klaviyo, and in Q1 last year, 24% of total revenue was attributed to Klaviyo. When your brand celebrates difference, your marketing should too. If you want to turn personalization into a serious growth lever, head to klaviyo.com/au and see how brands like Nala are scaling smart. And when you talk about founders being across their numbers, what's the most common way you're seeing that happen? Is it through monthly reports that you give them? Is it from them being in their Xero dashboard every day? Like, what's the best practice in terms of staying across your numbers that you see?
I think Xero and accounting software is not good for daily reporting.
No.
Right? It's terrible, right? Because things aren't reconciled and you don't have live data. The approach that I see that tends to work the most, particularly when you've got maybe a more static business or a consistent business, is you have monthly reporting that comes out of Xero that looks at, on a whole of business basis, what was your revenue and discounts, et cetera? What was your gross profit margin, contribution margin? We'll send a Xero report with MER in it as well. Mm-hmm. EBITDA, net profit, the whole lot. Look at that on a monthly basis in conjunction with your cash flow and your balance sheet. And so you get a whole pack out of Xero that is tailored to e-com businesses, not the standard report because they're crap and they don't work for e-com. But then on a day-to-day basis, people tend to be in their Meta and Google accounts and Shopify just looking at what is ultimately their marketing efficiency. So if you know that your target is that you need, I don't know, a return of 4 times or 5 times, and that's your target because you understand what your gross margins are, et cetera, then you can monitor that on a day-to-day basis across campaigns and what have you. And then when you get to the end of the month, you go and say, right, what happened last month? Did it work? Did it not? Where did we go? Where did we go wrong? What worked well?
Okay.
So I think the combination of monthly reporting, anything more frequently from Xero's, it's either inaccurate or it's too expensive to maintain.
Yep.
And then your day-to-day finger on the pulse stuff is your Shopify reporting and straight out of Meta and Google.
Okay. And you're finding most business owners are looking at the numbers from just a whole of business perspective, or are they looking at it from a category perspective or even a single product perspective?
We rarely do single product perspective because, again, it tends to be a little bit overkill, but we
Yeah.
will often segment things in terms of either geographic. So if you are selling in Australia and in New Zealand or in the US or what have you, then we would tend to report on country by country. We will tend to report on retail versus wholesale versus online. So if, we have clients that have all three, it's helpful to understand what their margins are at the store versus what they're doing with their wholesale customers, et cetera. So usually segmenting it to that extent is probably as far as we usually go. On a product by product basis, I mean, you need to understand your unit economics. And
Yeah.
so often I find that tends to be done when you're working out, when you're sort of onboarding a new product or creating do the numbers work? If they work and they fit within your threshold, then fantastic.
Yeah, that makes a lot of sense. When you have clients that are growing and they're opening up, say they start as e-com, go into wholesale or maybe even go into their own retail stores, are you seeing those different business units impact each other? So are you seeing the investment in one uplifting the other, or do you see them as still operating very separately?
In all honesty, we tend to not, it's hard to track, and it's hard to track from the numbers we're looking at, which is like the zero data, right? Like it's very, I don't know. I don't think I have enough detail to know. I mean, I imagine it would.
Yeah, yeah, yeah.
I imagine that the brand across all of those segments would improve. We have a client that sells in the beauty space. I know that they receive retail customers as a result of their wholesale into other businesses' retail space. So their repeat customers might come direct as opposed to from the wholesale, but it's probably business by business.
Yeah, that makes a lot of sense. I suppose it's the same with marketing, right? Is that you don't see the individual channel or campaign level, and attribution there is still horrible.
Awful.
Yeah.
I was talking to a client the other day who their attribution reporting between Meta and Shopify was like 30 grand out on 100 grand a month worth of revenue. And you just go like if you looked at the return on ad spend in terms of what Meta said, it was 1.8, 1.9 maybe. And was a good number for this particular business. And then you go and have a look what Shopify's saying, and it's like 0.8. And you go, well, like, who knows? And I didn't know. I don't know the answer to that question. I
Yeah,
mean,
I was
I
about to
spoke
ask
to
you,
him
who
and
are we
said, hey,
trusting here?
well, exactly. And I know Meta's obviously going to inflate their numbers because they want to promote,
Yeah.
they want you to sell more stuff through them. But it's, if I was an e-com business owner, I would find that would drive me nuts.
Yeah. Oh, it drives everyone nuts. It's
Yeah.
like, we
Shocking.
can't believe we're in the age of AI and we still haven't solved attribution. It's kind of like
Yeah.
we've left that one
Yeah.
behind, and it's like, well, I don't think we'll ever get the answer for that.
Yeah.
I'm curious to pick up on a conversation, and please, no one fall asleep when I mention tax, but you mentioned right at the start the surprise that comes at this time of year in February, March around BAS, because it catches up from all the massive sales that we have in Q2. What are your tips for your founders on planning for tax, especially around just making sure that you've got visibility of what's coming up, that you've kind of put money aside, that it's planned for and doesn't catch you by surprise? Because I know there's a lot of businesses that have gone under purely by being surprised by tax.
Yeah. And it's a horrible trap to get into because as soon as you miss one, particularly a big one this time of the year, there's a payment arrangement with the ATO. And then the next quarter comes around and all of the money that you would have put to that quarter's paying your payment arrangement, and it snowballs, and it's like, it can be really hard to get out of. I think there's some super easy wins that you can do to be visible. So the first one is in Xero, you can have an account watch list sitting on your dashboard. So as soon as you log in, there's an account watch list section. You can add accounts to that. Add your GST account, your PAYG account, and your super payable account. That is going to cover off on most of the things that are in your BAS lodgement, basically, and your quarterly super payments to staff. If you look at the year-to-date column on that, that's how much you owe, basically.
Yep.
So start there. The second thing is go and get a separate bank account. Don't lump all your cash in together. My recommendation with bank accounts is generally you've got your day-to-day trading stuff, so pay your expenses, what have you. You've got a savings account for your tax and BAS as well. Usually some kind of rainy day account. So just stockpiling some cash in case it all goes to shit. And then a profit account, like park some profit in there and set it aside. And that's the fun account. That's the one you want to build up. But if you start tipping cash into your BAS every time a Shopify pays you out, or you just do it on a weekly basis or what have you, you'll just build up a cash reserve there. And then when the BAS comes around, you've got the money set aside.
Don't touch it.
And don't touch it. Yeah. So that's the dangerous thing, right? Some big inventory order will come in and you just go and dip into that to pay it. It's a dangerous game. The other thing that you can do is if you've been in business for a little while, you'll generally know what percentage of your sales goes to GST. It's rarely ever 10%, right? It's somewhere between there. So you could basically say, right, for every dollar that comes in, historically, I've paid 5% to the ATO and GST.
Mhm.
So every day or week or month or what have you, as soon as the money comes in, put 5% into that bank account. That's a really simple way. If you're running payroll, when you run the pay run, the PAYG number is said, it's listed there. Take that, put that in the bank account, save it.
Is this all still manual? Is there any automated way to do this?
There is no automated way to do this, regrettably. It's still a manual intervention in terms of you've still got to go into internet banking and do the transfer.
Yeah.
Some people will set up like recurring transfers and that type of thing, but e-com business is rarely consistent enough to know exactly how much to put aside. But I think that the worst thing you can do is ignore it, because it will bite you in the ass. And when it does, it's a really hard thing to get out of the ATO debt. So just from the very beginning, just get visibility over the numbers, zero dashboard, ask your accountant or your bookkeeper, hey, what's the average percent I usually pay in GST? Those are the two easiest ways. Put the money in a separate bank account. Don't touch it.
Great tips. Great tips.
Expanding into new markets isn't just about selling more. It's about selling smarter. Every region has its own rules, currencies, and customer preferences. But with Shopify, global expansion is simple. Localized storefronts, tailor experiences, and build trust, all from one unified platform. Shopify removes complexity so that you can focus on growth and deliver tailored shopping experiences for every market, in-store and online. Accept over 100 currencies with Shopify payments for fast, familiar checkouts, and use built-in analytics to identify your most profitable markets. One platform built for global adaptability so you can scale without growing pains. Visit Shopify for Enterprise to learn more and start selling worldwide.
The profit account is really interesting. A philosophy that's come to light over the last 10 years is profit first. What's your take on that? What's your thought around founders carving out profit first before anything else?
I don't necessarily agree with the message, particularly when you're trying to grow a business. I think that the principle is good. Well, the thing that I take away from it that I like is that you should be doing this to create a profit. So that goes back to my comment earlier about don't just not pay yourself anything, investor. You have to make sure that you are getting something out of the business. So that profit could be in the form of, hey, I'm paying myself a wage every month so I can live. It might be that you put away some cash in that profit account so that it's there. But e-com businesses are notoriously expensive to grow. You need to spend an ungodly amount of money on stock that might take 90 days to land. You're buying stock from a lower profit period to fund a more profitable period as you grow, which is really tough. So you need more cash than what you're actually bringing in order to fund that. So like deliberately saying, well, I'm going to put 15% in this account no matter what, and then only spend what's left. It might be helpful now, but it might actually hinder growth. So I think that,
handcuff you.
yeah, I like the idea of it, but I think that if you're going to make an educated decision with the right numbers to go and invest in your business to grow, personally, I don't have a problem with reinvesting that profit, as long as, like I said, you still take something out of the business.
What's your take then when a client comes to you and says, hey, Matt, we see a huge opportunity coming up. We actually don't have the cash with us right now. We'd like to borrow some money to buy inventory. What's your first reaction?
I don't have a problem with debt. I think that debt used wisely is actually, it's leverage, right? So it's leverage to go and grow this business. So debt is helpful, particularly when you're thinking about it in the context of inventory, is that you can then service that debt out of the profits from selling that inventory. So to me, I've got no problem with debt, but where I see the problems with debt is if you're putting debt behind a product that doesn't make any money.
Yeah.
Which is crazy. So as long as you have good unit economics and you know that this particular cohort of inventory is going to generate me the return, then as long as you set aside some of the profit from that to actually repay the debt, I think debt can be a very helpful tool to grow the business.
And any tips from what you've seen, and I know this is not your specialty at all, around structuring debt for inventory? Any rules that you like to play by or advice from clients that you've seen go down this path?
Most clients that I see are just taking Shopify loans, PayPal loans, that type of thing. I mean, it's easy capital to get. Usually, it's forced payback from your sales as well. The downside risk on a lot of debt is personal guarantees, but we're in Australia, and in Australia, you can't get debt without security or personal guarantees. So it's kind of a necessary evil. I don't often see clients get bank debt for inventory. And I think that's just because banks won't lend on cash flow. So unless you're willing to put your house up, it's not going to be possible. So I don't think there's anything special with debt. I think, like I said, as long as you have margins in the product that is going to create profit, then debt's okay.
Yeah. And it would be remiss of me not to mention one of our partners this year is Cogs Flow, and they're specifically there to help fund and lend money to e-commerce founders for inventory. So specifically for e-com, because I think you're right, is that banks aren't set up to do it. So a lot of people default to Shopify, PayPal, because it's structured for e-com. So it's good to know that there are more options opening up there. From a forecasting perspective, because I think this is the one thing that is really hard in e-commerce is forecasting what it is. Because when you're talking about, what's the next year going to bring? Is it going to be 2% growth? Is it going to be 15% growth? I've had crazy years in the last few years where it's been 50 to 100% growth.
Yep.
How do you approach forecasting with your clients?
I'm going to be honest, we don't do a massive amount of it. I think that forecasting for clients in e-com really is more a marketing thing than anything else, right? So ultimately growth in a lot of e-com businesses driven by paid advertising. So you need to have the plan with your marketing team around what that paid ad looks like and what the potential return is going to be. And then you need to ensure that you've got inventory to make sure that if you're going to go and spend the ads, you've actually got the stuff to fulfill the orders. Like, worst thing you can do is spend money on ads for products that you don't have, right? You've run out of. So I think if you've got a good marketing team who are forecasting what the campaigns look like and how much money you're going to put behind it, and that they're doing that in an informed way with the right numbers, so they know how much they can spend on these products because you know what your unit economics look like, then you let that marketing drive what your capital requirements are in terms of inventory and those types of things. And so that's why we don't do a massive amount of it, because we're not the marketing team, and it all really hinges on how much money you're going to put behind ads, because that drives sales. And obviously that then drives how many products you need to sell and what you need on the shelf at any point in time.
Yeah, I hear what you're saying. I think from a founder's perspective, that can be really scary, right? Because if we talk about founders being optimistic, marketers are wildly optimistic.
Yeah, absolutely. Yeah. I mean, anytime we've done any modeling, we always have an aggressive version of it, which would probably be what your marketing teams would come back with. You've always got a conservative one, and then you kind of take the average of the two, and that will give you 3 different options about which way it might go.
Yeah.
Now, if you can survive and things are going to be okay, if you have the pessimistic view, then go for it, like happy days, right? If your pessimistic view is like it's all crash and burn and, you know, it's not sustainable and you can't do it, then I think you've got to be maybe a bit more cautious about the way you go about the growth. And again, your growth has to be chasing contribution margin.
Yeah.
Like, don't chase revenue. It's, again, a vanity metric, and it's not worth anything to you, really.
And I think too, you've got to think about why you're forecasting in the first place. It's not forecasting to try and pick the right number. It's forecasting to what you were saying before around helping speed up the decision-making process. So if it's scenario A, B, or C, here's the path that we're going to come down. If it's really bad, if it's the pessimistic version, we've got some pre-thought of plans that we'll put in place that aren't emotional or reactive because we've kind of envisaged this scenario. If it goes gangbusters and it's our wildly optimistic version, we've already got some things in our head of ways we'll double down and expand that growth and take advantage of it.
Yep, absolutely.
It's not about being right or wrong in our forecast, right?
No, it's about being prepared, and it's about being, or at least feeling, in control of what's going on. Like when I run my business, the worst times have always been where it's out of control. Now, maybe that's a personality type. Maybe I just need to be in control of things. But I tend to find that like giving business owners the information, even if it's bad, right?
Yeah.
So even if you're on the pessimistic path and it's not looking really good, if they've got the information, then you feel like you've got control, and then you can make decisions that are going to help you rather than just like flailing around hoping that something works.
Makes a lot of sense. And that's why people pay you the big bucks to be on their side. You don't need to laugh at that.
Yeah, no, that's all right. I was laughing about something in my head there. So I probably should charge. Probably should charge more, I think.
Matt, tell me about the next 12 months. What does it have in place for yourself and the team at Day One Advisory? Where will your focus be?
Our focus is, I mean, the interesting thing in accounting at the moment, and every industry is the same, is AI is coming, right? And all your jobs are knackered. Things in the past that were needing to be done, like the reconciling and stuff like that, is getting easier. We're spending a lot of time on integrations and building automations in so that we don't have to spend as much time on that. And the upside there is that we're then going to start repurposing our time into things that are going to add more value.
Yeah.
So, for example, like at the moment, all of our clients we do the bookkeeping for get a monthly report out of Xero, and it's a formatted report, and it looks good, but it's still ultimately just Xero data. So then it's like, okay, well, we're going to start building out our own dashboards that visualize that data a bit better for people. So for us, it's about how can we help e-com business owners get more visibility and clarity over their numbers. And so we're going to start spending a bit more time on things that add more value rather than like click reconcile in Xero, right? Which, to be perfectly honest, nobody gives a shit about.
No.
And even we
Ought to
don't
be
love doing
done.
that. So it's a necessary evil that thankfully is getting easier.
Yeah.
And my time is all spent at the moment on automation and improvement, and how are we going to take the things that we've already got and the data we've already got and make it more usable for clients.
And give you the business insights. I mean, that's a lot more fun for you as well, right?
Way more fun. Way more fun for everybody. Yeah, absolutely.
Matt, well, thank you so much for joining us on Add to Cart today. You have given us a lot of insights there from both practical, but also from a mindset perspective for founders around how to run their business. And every time that we have these conversations, there's always one or two things that I pick up. Even though we talk a lot around gross profit and contribution margin, everyone has a slightly different angle. So really appreciate you sharing that with us today. I've got no doubt that some of the things you've talked about, even the little implementations, will have huge impacts on the businesses that are listening. So thank you very much.
Nice. Fantastic. Thanks for having me.
I don't know what it is, but I've got a thing for those financial conversations every time we have them. I have a little breakthrough, a little bit of clarity around what makes an e-commerce business really healthy. It's always fun to talk the tech. It's always fun to talk the marketing, but this is the real nuts and bolts stuff. And the more you can get your head around it, the better your business will be. All right, there are 3 big takeaways that I took from that conversation with Matt. Starting with number 1. I think there was a big thing there around deciding whether you are chasing revenue or contribution margin. I'm not even going to throw profit in there at this stage. We've talked about that before. I think contribution margin is worth talking about because Matt was very blunt. He said you can have a 60% gross margin and still make nothing if you're overspending on acquisition. I think we've all heard those stories. Contribution margin is gross profit minus ad spend. And we know how significant ad spend can be. So whatever is left over is your contribution margin. And that's the number that pays your team, your subscriptions, your rent, and eventually, hopefully, you. So it's really important that you know your blended MER and what margin is left after ads. Don't just celebrate top line growth. And the second one is related, but you need to decide what revenue actually needs to be, but based on your break even. Matt's point on break even was really powerful. If your overheads are $50K a month and your contribution margin is 30%, you need roughly $167K in sales just to stand still. Not 1 million, not 10 million. That's enough to cover the machines. So once you know your break even sales number in dollars and in units, you can then pick a revenue target that doesn't just sound good, but you know that's your safe number. Once you know your safe number, you can make better decisions. Third thing that I will leave you with is probably a little bit more psychological than it is financial, but you need to decide why you actually want to grow. And I think we all relate to this, whether we are running an e-commerce business or not. If your goal is $10 million in revenue, you've got to sometimes ask yourself, is that because you need $150K a year to live comfortably, or you want to spend more time with your family, or just because 10 million? That sounds like a pretty impressive number, right? Matt sees how much founders sacrifice in salary, sleep, insanity, to chase a vanity metric. And his view is always make sure you're paying yourself. Treat your salary like an overhead and then grow. Make the decision on whether you're building a business to impress other people or to fund your life. It's kind of important. Now, if this episode hit a nerve or made you open your P&L straight away, that is a good thing. That's exactly the kind of conversation we continue inside the Add to Cart community. You can join us over on addtocart.com.au. It is free to join. We have over 600 e-commerce professionals in there trading tips, questions, thoughts, and you can continue this conversation there. Sign up over on addtocart.com.au. All right, I'll see you next week.